While market capitalization-based index funds and ETFs can constitute the core of an investor's portfolio, now they also have a wide variety of smart beta funds or factor-based funds to choose from. As you are aware, trends within the market change. Sometimes quality does well, sometimes value, and sometimes momentum. Adding these factor-based funds to your portfolio can add a kicker to your returns. On the occasion of the launch of ICICI Prudential's Nifty 200 Momentum 30 Index Fund and ETF, Chintan Haria, Head of Product Development and Strategy at ICICI Prudential Mutual Fund, spoke to Business Standard on how factor-based investing works. He also explained the role that the Nifty 200 Momentum 30 Fund in particular can play in an investor's portfolio. Good afternoon, Mr. Haria. Thank you for joining our show.
Thank you, sir. It's a pleasure always.
So ICICI Prudential already has a number of factor-based funds, and now it has launched the Nifty 200 Momentum 30 Fund. So I thought this would be a good occasion to discuss factor-based investing. So I would like to start by asking you, what are the advantages of a factor-based funds? How does it score over the normal market capitalization-based index funds that we have?
Sure. So as you rightly mentioned, it has been our endeavor to be a one-stop provider of all potential investment avenues, both on the active and passive side. And with that endeavor over the last 3 to 4 years, we've added a lot of funds on our passive bouquet as well. So like you mentioned, not just the large cap indices, but also on the sector and thematic side, we have many sectors on which we've launched ETFs. And I think, as has been the case globally, the trend towards smart beta investing, we also caught on to that way back in 2017. And today we have smart beta ETFs on value, low volatility, alpha plus low vol. And we're very happy to launch, as you mentioned, a smart beta product on the momentum as a factor. To answer your question, what is the advantage of a smart beta portfolio over a diversified portfolio? I would look at it this way, that an investor's overall portfolio does require a blend of everything in order to ensure that, basis risk reward and different market cycles, they're able to ultimately catch up with the right trend and make wealth in the markets. And with that endeavor, smart beta ETFs have been popular on specific factors such as low volatility, momentum, value. Globally, dividend yield, of course, has been very popular. In India, we've seen a growing trend towards smart beta because investors are looking at diversification of their existing holdings. And as our financial savings increase, more and more products are being sought after. And hence, we are launching these products to ensure that to each investor, based on their requirement, they're able to plug in, and we can go in detail over how this particular smart beta factors help versus a broad-based index. But just to kick off the discussion, because they are basically picking stocks on the basis of a particular factor or a combination of factors, the investors can get the benefit of that particular factor doing well in a market cycle and end up getting that extra return. So let's say theoretically when value plays out in the last 1 year, we've seen value stocks outperforming growth. And if value is an ETF or a value as a smart beta you have in your portfolio, it can give you that kicker in a year like 2021, 22, where value has actually outperformed growth. Quality did exceedingly well before that. So between 2017 and 2020, you would be in quality. Quality as a factor did well, you would end up doing well. So yes, it does require a bit of understanding on the part of investors. Most investors, when they start their journey of investing, they would start with plain vanilla 50 stock broad market index, 30 stock broad market index, or otherwise simple index funds. But as they move along and they understand markets a bit more, they pick up these factors from which to choose.
Are these all-weather products, or should investors enter and exit them according to the market environment, or take an advisor's help to do so?
So I think as a base case, it's always good to take an advisor's help from an overall portfolio allocation standpoint. I think that is a must, and it is the most overlooked ingredient in the financial health for all investors. You must have someone to guide you in the right path, because it not only helps you to be invested in the right place, it helps you to be invested in the right proportion, and it also helps you to avoid investments which can potentially cause you harm or cause you losses. So if a financial advisor is a professional financial advisor, can actually help you a lot in terms of getting your sizing right, your timing right, your selection right, and also avoiding what you should not have in your portfolio. So that's the basic, as I would say. And then you spoke of seasonality, or you spoke of, there are trends. Yes, there will be trends in each factor doing well. Like, and I had mentioned when we were discussing briefly in the introduction, quality did well over last 3-4 years between 2017 to 20. So quality as a factor does well. Pharmaceutical, if I have to pick up a sectoral index, did well between 2020 to 21. Maybe now is the time for auto to do well, or banking as a sector is picking up. So it does require a bit of nuance. And in the case of smart beta or factor-based investing also, there are some which can be all-weather. There are some which will probably be, in spurts. But if you consistently apply that methodology and stay invested for the long run, we've seen that most smart beta factors such as low volatility or momentum ultimately end up generating wealth for the investors in the long run, which is what basically patience is all about, and you need to be invested. So the broader factors such as low volatility, momentum can be longer term investments. In fact, as we will speak along later as well, evidence of the past returns in terms of the index returns has shown that the longer you remain invested in, let's say, a low vol or a momentum, the better it is in terms of your risk-adjusted returns.
So we'll talk about the Nifty 230 fund. How is the index for this fund composed?
Sure. So the latest addition in terms of our portfolio, where the NFO is going on right now, which is the Nifty 200 Momentum 30 index, on which we are launching the ICICI Prudential Nifty 200 Momentum 30 ETF for those who have Demat account, as well as the index fund for those who do not have a Demat account. Both are being parallelly launched for everyone to be, for allowing everyone to participate, whether you have a Demat account or you don't have a Demat account. The index itself, that the momentum index, as the name suggests, is part of the smart beta bouquet, wherein the stocks are selected out of the universe of 200 names. So out of the 200 names, 30 stocks are selected. Those 30 stocks which are selected are on the basis of their past 6-month and 12-month price momentum adjusted for volatility. And once you have those 30 stocks selected basis their price momentum, you basically end up having weightages on those stocks basis the momentum scores plus their market capitalizations. So technically, the larger market capitalization names will have a slightly higher weight in the 30 stocks that are being selected. There are inbuilt risk measures like no stock can be more than 5% weight as on the rebalancing date. Plus, if you look at the constituents which can be selected in these 30 names, they have to form part of the futures and options market or the derivatives market, which other words makes it simpler in terms of their impact cost, in terms of their liquidity in the markets. So when we construct a product, it is in the interest of investors that the scalability of the product, the replicability of the product, and we are also able to efficiently do the rebalances which happen every 6 months. And to that effect, I think the construction of the methodology of the ICICI Prudential Nifty 200 Momentum 30 ETF and Index Fund is reasonably well balanced, wherein you have a stock capping of 5%, you have only derivative linked stocks, you're picking up 30 stocks out of the 200 names, and these 200 names in general are liquid by itself. So Those are the risk measures and the selection methodology of this particular index.
Could you tell us a little about what the back testing of the index has shown in terms of performance? Has it been an outperformer? To what extent?
So the numbers of the index itself, and the index is a public index from NSE Indices. It suggests that any time horizon, if you take a longer time horizon, let's say 10-year time horizon, in the last 10 years, 8 years out of 10 years, the index has been able to do better than broader market indices, comparable indices. And more importantly, when the market does well, there is a tendency of these 10 names which are winners. So by definition, what is momentum? And as I explained earlier, the stocks which have shown better price performance over the last 6 months and 12 months adjusted for volatility have picked up. It means basically you're betting on the winners, or you're investing in those 30 winners which have done well. And when these 30 winners which have done well, if the trend continues, and it normally happens in an uptrending market, you end up getting a slightly higher return, or and that has been shown in years like 2012, 14, 17, 21 calendar years, wherein markets have gone up and the performance of the underlying index has been better, which allows investors to get that added alpha, even though, or the added returns, even though the risks, as they sound, because it is momentum-oriented stocks, looks higher, but the returns more than compensate for that in terms of the back data that we've seen. So I think from an average return perspective, for anyone who's stayed for more than 3 years and 5 years, if you look at data from 2009, the average returns in the case of momentum index has been better off. So we are of the belief that investors who peacefully invest in this and stay invested patiently can get the benefit of the trend working. The times that it does not work is when the trend change happens. So we saw trend change happening in 2018. We saw trend change happening right now in the last 6 months, wherein the markets have kind of turned towards the negative because of all the interest rate hikes and the inflation fears that are there, and it underperforms. So if I look at calendar year to date, the index has underperformed the broader market indices, but that's on the back of 2021 being a very good year. So investors should treat it as a longer term investment and not a quick in out kind of a product. And that will allow them to participate in the long term compounding, which comes when you keep between the different sectors that the stocks are selected based on their price momentum.
Should investors hold this fund in their core portfolio, or should it be a part of their satellite portfolio?
So I think we've always believed that core portfolio should be your dynamic asset allocation funds or the balance advantage fund category as a product where you are basically on the sensible basis of some valuation metric, buying low, selling high, reducing your equity when markets become expensive, increasing your equity when markets become cheap. That becomes your core. So core allocation, of course, is the dynamic asset allocation funds. Within the allocations that you have to equity, we do believe that if you want a pure equity fund where your allocation should be there, this product can pretty much fit in there for the long term, because ultimately you are at all points of time on a 6-month basis, there is rebalancing which happens. So you are continuously being part of the winners of the recent past, and that also trend is my friend, as they say, can capture you with long-term, portfolio gains or value creation. So this should be forming part of your portfolio of equity funds which you have, while the core portfolio, as an overall portfolio basis, we always believe should be the balance advantage fund category.
And what kind of investor should go for it? Does this fund require a slightly more savvy investor who can perhaps tolerate higher volatility?
I think, as I had mentioned earlier, there is a definite certain level of understanding required by investors on what to expect from smart beta, and hence our experience has been over the last 3-4 years, as you mentioned, people who have slightly more knowledge about markets or about factors, or those who have done a bit more reading, they are basically the investors who have been investing in this. But our belief is that anyone or any investor who has the patience for more than 3 to 5 years and longer to invest, and has, more importantly, the ability to invest in equity markets, can potentially select this as one of their investments as part of their equity investments. You don't necessarily need to be a very savvy investor or a very well-informed investor. But yes, after doing a basic work on overall asset allocation, if there is a scope to add equities in your portfolio, then the momentum as a factor will add that bit of a tailwind to your overall portfolio when the markets do well. But yes, it is important to understand the portfolio or the methodology, and hence a novice or a person who is investing for the first time may find it difficult to immediately invest in the momentum as a concept.
Thank you, Mr. Haria, for explaining the concept of your new fund. I sincerely hope that investors in India will take to factor-based investing in a big way. Thank you so much.
Thank you so much, sir. As always, it's a pleasure. Thank you.
Goodbye.